Investing like Peter Lynch. Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee, because I thought today we'd have a talk about Peter Lynch and learn something about this fantastically successful investor. What takeaways can we get from learning about the greats? Now, if we jump here, I'd like to start by just, let's get a bit of an overview of Peter Lynch. Now, he is an American investor and mutual fund manager. He's also now a philanthropist. He's became famous for when he took over Magellan in 1977, and until 1990, he was getting annual returns of 29.2%. Now, to some people who are used to crypto returns, that may not seem as exciting, but remember, this is in a normal market. He was doubling the S&P 500, everyone. He was one of the world's best performing mutual fund managers, although Nancy Pelosi is probably beating him at the moment, but that's another thing. So I thought it's very interesting to learn what we can from people who have gone before us and highly successful people. Let's start by just looking at a few little clips from an interview that Peter Lynch did some time ago.
Peter, many viewers want to know whether this market is totally different, whether your old view that people should find, buy, and hold good stocks is no longer applicable. What do you think?
I think the same rules applied 50 years ago, applied 5 years ago, apply 20 years from now. First of all, you have to know what you own, whether it's a fund or a stock, and you have to have a reason for it. And you ought to be able to explain to an 11-year-old in 2 minutes or less why you own this. And this sucker's going up is not a good reason. I've tried that one. Doesn't work.
Peter.
And that's a very good principle. It's one of the three kind of guiding principles that Peter has, is you've got to know what you own. You've got to understand and be able to explain it to a 11-year-old, to a child, why you own a certain business. Now, I challenge you just to, as we're watching this today, think through your portfolio, how many businesses you have, what have you invested in, why do you own it? There was just recently a piece where a well-known investor was spruiking a stock that had gone up, and he was faking having a disconnection on the internet connection when they were asking him about the business. They were saying, the interviewer was saying, I've never heard of these businesses, what's going on? And he was faking, disconnecting, because he was just buying it because this sucker is going up. Now, Peter is a long-term investor, everyone, and he invests for the long run. So here's
what do you say to investors now who say, Peter, everything I own's gone down. It's been going down now for a couple of years.
Right.
People keep saying we're at a bottom.
Right.
Should I get out and go into CDs or gold bars and opium or whatever?
Right.
That's interesting. I mean, remember, this is some time ago. This seems to be, we're kind of at the opposite now. People are worried it's about to burst, it's about to go down, to get out and get into gold bars, get into crypto to protect your wealth. Let's see what Peter has to say about this. This ties into his long-term perspective.
Well, basically, you look now, you have three choices. I think if you're an investor, you can put your money in a money market fund and get 1.7, 1.5, 1.6, and it's taxed at a 40% rate. Or you can buy a 10-year treasury and get 4.7.
This is dated, guys. Okay, this is dated. Dated. Remember what he's getting on the treasuries. Positive on bonds. Wow.
That's taxed at a 40% rate. Or you can have some equities. And I think stocks over the next 10 years will do a lot better than 4.7 or 1.7. So I would have some of my money. Now, it's up to the person to decide how much they want to have in the stock market. For some people, 10% is aggressive. For some people, 50% is the right amount. It's a personal decision. And you can't go by these rules that if you're 25, you should be 100%. And if you're 45, you should be 50%. And if you're 60, you should be 0. And I guess burping a lot. I don't know what the rules are on people at 60, but I hate those rules. I think they're pathetic.
Why are you confident that stocks will be a lot higher in 10 years?
Well, they're not lottery tickets. I mean, when you own a stock, it's a share of a company. And I think companies are going to make a lot more money in 10 years, a lot more money in 20 years. And that's why they go up. That's the only reason. Some companies don't do well. Zero Huxes make a lot less money than they did 30 years ago. It's a lot less. But more companies are earning a lot more money than they were, and that's why stocks go up. Corporate profits have gone up 40-fold since World War II. Stock market's up 40-fold.
So that's another good point. Businesses are going up. Here's one: advice to scared investors. I thought this was a good one too.
If you could give one sentence of advice to scared investors right now, what would it be?
I think you ought to see some kids. Hire an 8-year-old, hire a 6-year-old. Just watch them. They don't know who Alan Greenspan is. They know about the shape of the yield curve. They're optimistic about the future. We'll be fine for the next 30, 40 years.
Well, let's hope you're right, Peter. Courage and persistence, they've worked in the past. There we do have to stop with thanks to Peter Lynch and our panelists.
And I'd like to show one more clip here. And this is quite an interesting one. Peter Lynch's take on deficits, everyone.
We have less than a minute left. Those who are less sanguine about the economy than you've just expressed often cite the recent declines in the dollar and the shift from surplus to deficit as negatives. You seem to indicate that they're positives. Why?
Well, I think the government running a deficit is terrific. That's the way it should work. I mean, when they were running a $200 billion surplus, which they're taking $200 billion out of the economy. Now the government's running a $100 billion deficit. It's
$100 billion deficit. Anyway, a different time.
Pumping $100 billion in. It's a cushion.
So you don't see a double-dip recession coming?
I don't know. I can't predict the future. That's a healthy thing to have buffers in the economy. We've had 9 recessions in World War II. We've got out every one of them. The system works.
So there's some clips from Peter Lynch, and I thought we'd have a look at just some quotes and go through them. This is from Goodreads, where people can like and identify quotes. So the trick is not to learn to trust your gut feelings, but rather to discipline yourself to ignore them. Stand by your stocks as long as the fundamental story of the company hasn't changed. That's some good advice. How many people have FOMO'd out of decent companies in the huge dip we had last year? How many people jumped out of fear and, well, didn't time in right at the right time, guys, or missed out on opportunities? It depends on what you're investing. If you're trying to play the swings, play the news, that's different to the strategy he's doing with long-term investing. Know what you own and know why you own it. Okay, that's a good one too. Here's some other ones. Whenever you invest in any company, you're looking for its market cap to rise. This can't happen unless buyers are paying higher prices for the shares, making your investment more valuable. Go for a business that any idiot can run, because sooner or later, any idiot probably is going to be running it. I thought that was quite a good one. And here's an interesting takeaway. Big companies have small moves. Small companies have big moves. So those were some interesting quotes. And so here's his strategy, just, boiled down into 3 nascent points. Understand, or only buy what you understand. Understand what you're buying. Always do your homework and invest for the long run, everyone. So have you done that for all of your investments? Do you truly understand what you're buying? This is one of the things with a lot of people jumping into crypto. Do they understand what they're actually buying? Or are they going for the hype? Are you FOMOing into something? Do you understand the company that you're buying in is a sector that you're familiar with? And, have you done your research and your homework? One good thing, if you're interested in learning more from Peter Lynch, is to look at some of his books. And I thought we'd look at some here. And this is One Up on Wall Street. It was written in 2000. How to use what you already know to make money on the market. Now, I've been listening to that as an audiobook as I've been driving around. Quite a good one. I'd recommend it. I recommend all of these ones. Peter Lynch, Beating the Street, 94. Now, these are older books, so some of the anecdotes and things are a bit dated. But the principles are what you want to learn here. It's what you want to take away, everyone. Learn to earn. A beginner's guide to the basics of investing and business. So in 96. And, well, I thought what we do is, as a stepping stone or a video to go on to, is to have a look at this one I just recently did, Investing for the Great Reset, where I discuss 4 shares that I'm buying because, the meme where you'll own nothing and you'll be happy. That's looking at shifting towards a renting economy where we're investing in products and things that we're renting out. So guys, I'd encourage you to have a look at this video to find out the 4 shares that I've moved some of my gold investment over into to take advantage of this emerging renting economy. Thank you all for watching. Let me know your top investment hints and tips in the comments below and what strategies or suggestions you use.